Ah, the question everybody wants to know, is the Bitcoin a bubble? Is it going to go pop? Or is Bitcoin going higher and other altcoins? We're going to talk about that here in just a minute, but before I start, can you please do me a favor and subscribe to the channel? Thank you. So let's talk about whether or not Bitcoin is a bubble. Now, to do that, we have to understand what a bubble is. And it can be confusing because this is a very loosely used term in finance. Because according to the investment definition, a bubble is any time the asset price increases over the asset's fundamental value. Now, that's a very vague definition, and honestly, that could define probably 95% of all the companies that are currently trading on both the NYSE, the NASDAQ, the New York Stock Exchange, etc. Any stock right now, you could probably say that about. So that's a little bit vague. I want to kind of break it down for you a little bit because throughout my trading career now, I've experienced a few real bubbles, such as the dot-com bubble. That's when I first got started in trading. I also traded through the credit crisis bubble and a couple of other smaller bubbles in between and since then. Now, one of the things that I realized about bubbles is they have three main characteristics, and I'm going to call this, let's say, the bubble trigonometry equation. And that is time versus price versus the participant. I just gave up writing that word there towards the end. Now, if you watch some of these whiteboards, I've talked about, shorting strategies and other stuff that I've done before. And I've always talked about there's always an element between time and price. That's going to be easy for you to understand. So basically, anytime there is too much price increase in an asset over too short a period of time, then you're always going to have bubble talk and speculation. For example, something like gasoline. If you pay $3 a gallon, but they raise it 1 cent every week, you're not going to notice that. But if they raise it 50 cents one day, 75 cents the next day, and by the end of the week it goes from 3 to 5, you're going to have outrage by the public, and then you're going to have bubble talk. So there's always that time versus price element. So anytime an asset increases a lot in a short period of time, a lot of price, you're going to have that. But what's more important that really defines the bubble is the participant. So let's talk about it. Now, what we're going to do for this example is we're going to go back to one of the more nearer understandable bubbles, and let's talk about the real estate bubble, okay? Now, for most people, this was defined between a period of 2002 to 2008, okay? Give or take a little bit. Some will say before, some will say after. We'll just do this for an example, okay? Now, what happened here is after the dot-com bust, one of the ways to inject fuel into the economy was to lower interest rates. Real estate had been kind of in the doldrums a little bit, for real estate, I should say. And it was to lower interest rates and kind of kickstart the economy, okay? So back here, I'd say between 2002 to 2004, okay? Housing prices were relatively, I don't want to say cheap, but they were relatively affordable for most people, and they were trading at a fair value. Plus, at this time, mortgages became a lot easier to qualify, and interest rates, for the first time in a while, started to come down a significant amount. So people started to realize they could now afford a home and pay a fair price for a home and get a nice home. So a lot of people saw this. There were kind of two people involved in this, two groups of people. You have an investor, like a real estate investor, and then you just have like a single family that is just trying to buy a home to live in, okay? Now, the investors see this early, that, hey, this is a great time, better than the last 5 years or the last decade. This is a great time for us to invest into real estate or start purchasing some property. Now, the single family, some people might have saw that. The individual investor might have said, hey, this is a really good opportunity for us to finally afford a home. Some people, like myself, just got lucky because we bought a home there. We were in the market for a home. And these were great times because mortgages were easy to qualify for, and then you had options and you were paying a fair price for your real estate. Now, between 2004 and 2005, you really started to see heavy media attention and a lot of financial attention started to gear towards real estate. I'm sure you saw this in your area. This is back when newspapers were popular. You saw that every day on the front page. But real estate prices are going up 5% a month, 8% a month, 9% a month. You started to get this surge. Now at this point, this is where we're talking about the participant. The type of participant changes, but only at this stage does it change slightly. And what you're getting in here is both the investor and the single family home purchaser. But what you're getting is now the investor who passed on the opportunity. Maybe it's the group of people that said, you know, we were interested, but we better get it now because we're not going to be able to afford something. If it keeps going up 8 to 10% a month, we're going to be priced out of the market. So they start buying homes, okay? Same way with the single family, they have the same kind of mindset. It's like, oh, I just looked at the home last month. It was $180,000, now it's $210,000. I better hurry up and buy it. Now this is the beginning stages of the bubble because oftentimes, even though at this point they were saying this is a real estate bubble, one thing that we learn about bubbles that we always have to keep in mind is they can go a lot higher, last a lot longer, and go much further than media or even so-called experts or further than anybody can ever expect, okay? But what really happens here as we start to get towards 5 and 8, the whole perception changes where the mania, let's call it mania, starts to come in. Now what happens between this group of people and this group when I say mania is because mania creates a big problem, because what happens here, the key, which is going to relate to Bitcoin, is options, okay? When you were back here purchasing a home, you had options. You could buy a home, nice price per square foot, and if you were a single family buyer or just someone purchasing a home to live in like I was, you could buy a home that you really wanted. Something that had like a foyer, a pool. You follow what I'm saying? You had options, bedrooms. You could choose. And you were able to negotiate with the sellers of that home and get fair prices. Here, you've given up your options because now these people were paying 5 times the amount for the same property a few years ago. So what they're doing is they say, I want a pool, I want a garage, I want a foyer. And then what was happening, I can still remember that people would go in to look at a home and they would start bidding wars inside the house. Like, I want it. They would just walk in the door and say, I want it, I'll give you an offer. I can even remember, like, my whole entire street was for sale. And you'd grab a flyer and there was no longer like a solid price on it. It said, seller will entertain offers between $800,000 and $1 million, right? So now people have gone mania and they've given up their options. And they're just buying to buy, also known as fear of missing out. Now you may ask, why is this so important? Okay? Why is the participant so important in this? Because this is why things ultimately bust, why bubbles bust. Because it's these people that are in it for the wrong reasons. These people aren't aware of what they're doing and they're not conditioned for it. You also know during this time what was happening. Everybody was trying to flip homes. Everybody wanted to get in the flipping business because it's the next hot thing. Now, these people back here that were house flippers were probably professionals. I don't want to say that everybody over here was not. New people that got in were stupid. But the majority of these people were rookies, were amateurs. This is the same thing that happened in the dot-com bust with traders. Trading took off. Trading got media attention. There were traders that had been in it for years that was able to see it. There were morons like myself who came in, started day trading, making big bank to start and says, hey, this is easy, and weren't prepared for the correction. I've told my story before. Then they have the real estate, same thing. It's the participant. Because what's going to happen is the participant is going to get shaken out of whatever the asset is because they're not prepared. They don't know why they got in it to the first place other than fear. So when we talk about Bitcoin, you've seen this meteoric rise from Bitcoin. So, you know, I'd say at the start of this year, I can't remember off the top of my head. It's been a really, really long day. It was like $700. Don't quote me on that. I think that's what it is. But, you know, now you're over here at, I think the time I'm doing is 17K plus, okay? All right. So you're always going to have people tell you Bitcoin's going to go higher. Bitcoin's going to be great, okay? And maybe it will. But what kind of participant is here versus the participant here? You see, the early people, let's call them the first responders, that got in, I'd say all the way up to maybe 6 to 8K right now. They're in a much different situation than the people were here. So if I can give you a quick example, because I purchased my home back here, and it quadrupled in value here. When the correction happened, as bad as the correction was, it never got near the purchase price of the home because I got such a good deal on it. So because of that, I was able to ride the wave. So the people that have bought back here, I'd say all the way from, I'm being generous with 6 to 8K. They're in a different situation because these people can take out their balance, right? What they've invested in it, their initial investment, and now ride out the rest. So if Bitcoin corrects down to 5K, they're not in trouble. But if the noob who took some advice off of TV or was at Thanksgiving dinner and said, hey, my brother says I got to buy this Bitcoin, or some people walking into it at 18K, 20K here, if it goes down to 5K, they're going to poop their pants. They're going to panic way early. They're going to sell, and then the asset is going to crash back. And it's done it before with Bitcoin, right? And the purpose is, why I say this is it doesn't mean it won't go higher. We know real estate prices have now climbed back up. Tech stocks from the tech crash have. I remember Amazon, people were saying it was a bubble at 35 and 40. It went through its period of correction. Everything gets corrected. And I guess what I'm trying to say here is you have to ask yourself, what are you in it for? What kind of participant are you? Are you trying to make a quick buck on this thing? Or are you truly an educated Bitcoin or an Ethereum, Litecoin? Are you an educated trader or investor that can understand why you're in it? Because if you're in it for the long term, you say, I'm going to hold to 100, that's different. But be prepared that if it does correct, that you can ride through that you were focused on your investment goals. And this just doesn't go for Bitcoin today because there'll be other bubbles. If you never watch this video again for 50 years, there'll be other bubbles. There'll be other bubbles that come along. Stock market bubbles, real estate probably have another bubble, other asset types of bubbles. But remember, the point of all of this, and understanding what true bubbles are, more importantly than time versus price, is the participant. Who is in the trade? That's what we always want to know when we trade as traders. Who's in the trade? Who's on the other side? What will the person that only has $25,000 in assets and bought one Bitcoin for 18, what are they going to do when it drops to 15, to 14, to 13? How is that group of people? And usually what you have to do, unfortunately, to have an asset go higher, like an Amazon, like an Apple, like a Google, like the market, like real estate, is you got to get rid of these people. You got to shake out that group, bring down the prices, let things settle in, and then you begin a much stronger, more well-refined, grinded out type of asset increase. And that's what you're looking for. So ask yourself, what kind of participant are you? So if I could give you any advice about investing in this, I'm just like everyone else, man. I can't tell you if it's going to be $1 million or $2. I don't know. I don't have a crystal ball that works either. All I can say is at this point, if you choose to buy, number one, understand what you're getting yourself into and what kind of participant are you and what is your long-term objective with this asset. And invest money that you are willing to risk because we're still in a risk-averse environment, right? So anyway, guys, I hope this kind of helps you out if you want to learn how to trade. You want to learn more about coins. You just want to learn how to be good with money. Take a moment, visit thelincolnlist.com. Until the next video, thanks for watching. Take care.